Welcome to Smart Money Simplified with Brent Mekosh from The Wealth Stewards. In this podcast, Brent discusses some of the most important and interesting topics of the day as they relate to finance, the economy, and beyond. Now, on to the show.
And welcome to the Smart Money Simplified podcast with Brent Mekosh. Brent, good to be with you again. How are you, my friend?
I'm doing well. And I was thinking this guest that we have today is very timely because I was walking around my neighborhood. And if this has been maybe 4 years or so ago, I wouldn't say there was a ton of inventory, but there was quite a bit of inventory. There's a lot of houses for sale. We were also at a period of time back then where we had mortgage rates, hovering in the threes somewhere. We're talking 2019 into early 2020 at that point. And, so you had a couple of really great things happen. You had some inventory. You also had some lower mortgage rates. And I'm comparing that with today, and there's literally in my neighborhood, there's nothing for sale, very few houses for sale. And, our guests can talk a lot more about what's occurring in the mortgage market, but we're probably looking at mortgages in the sevens. And so we've got this really weird market where a lot of people have been, I guess, predicting that we might see some declines in real estate just based on what's occurred with interest rates. Everything's become a lot more expensive to buy. But it hasn't happened because there's basically been no price discovery. There's not much trading, so you don't really get an idea of where the market is. And I think that it's interesting because at least out here in Arizona, and our guest is from Colorado, the real estate that you own is one of your largest investments. It's one of the largest assets that you have on the book. And who would have thought, this kind of dawned on me last night, that one of your greatest assets in a strange way would be your 3%, your 3.5% mortgage. And so I think that what's happening, obviously, in terms of mortgage rates, really impacting everything. And our guest is in this world every single day. I got Kim Karras here. He is a real estate lending manager over at the Colorado Credit Union. I've known Kim for years. He's definitely the go-to guy to talk about with everything happening in the mortgage world. And hopefully he can shed a little bit of light on what the market looks like and what the dynamics are out there right now. So Kim, great to see you, my friend. And how would you like to introduce yourself? Give me some background in terms of how you got into the lending side of this economy.
Well, I graduated from the University of Colorado Boulder in 1996. So I have been in the real estate business since 96, seen the troubles of the kind of the mortgage meltdown in 2008, 2009, been through some of the lowest rates or the lowest rates ever in history in 2019 to 2022. And we're seeing the opposite of that today. It's like you had mentioned, low inventory, high rates. Affordability is a big problem today. And, it's tough sledding right now.
I think one of the interesting times, and as you said, you've been in the business for a really long period of time, and this is so different, at least what I see here in Arizona, from what you saw in 2008. In 2008, you had busloads of people, really 2006, 2007, that period of time, busloads of people from California coming in here, sight unseen, essentially buying houses before they were put up, 4 or 5 different houses. You had people that made very little money that could do stated income loans, that owned a bunch of real estate. And you had the builders at that point really, really overbuilt. And you had rates that I guess were somewhat competitive at that time. So you had this massive economic slump coupled with a ton of inventory. Where here we have an economy that I think for some people, inflation is really hurting them, but has proven to be a lot more resilient over the last couple of years or so than people thought coming out of COVID. But we've got much higher rates, and you're doing this in this market of scarcity. And so let's go back a little bit because I'm curious your thoughts. You brought up 2008. What was that like compared to what you're seeing now? You say it's tough sledding now, but how did that compare to what you saw during the financial crisis?
Well, 2008, we had the ability to pretty much lend to anyone. It was kind of a free market in terms of, I believe there was an initiative to help poor families obtain homeownership, where homeownership was more of a right and not necessarily a privilege to own. And the investors really pushed the limits in terms of their guidelines and what you could get away with. We learned a big lesson from that. Obviously, we saw the ramifications of that kind of lending and what it did, what it cost the taxpayers in terms of the bailouts and all that kind of stuff. But today, I think we're more in a situation where there's just simply not enough homes anymore. Prices are exorbitant here in Colorado. Our median house price is approaching 600,000. And
Yeah.
for a first-time home buyer, that is a pretty large mortgage payment for someone who may have student loans, children, and all the other expensive life is thrown at us right now.
Now, if you're talking about average home prices being 600 grand, give us an idea, where were they in 2019?
2019, I believe they're
Ballpark.
around 380.
Yeah, so I mean, you're talking a 40% plus, almost way more than that, actually. You know, you're getting close to doubling the cost of that, and you're doing that with the cost of the debt being so much higher. And to your point, the changes that were made post 2008, what are some of the lending restrictions that you have right now in terms of money down? I mean, are you doing these 0% down loans anymore? Is that even occurring in the market?
You still can get away with 3% down on a Fannie Mae conventional mortgage. There's something called mortgage insurance. That is the only insurance in the world that protects one person. And unfortunately, it's not you, it's the lender in case of default. Typically, we're seeing most people are somehow scraping by and putting down 20%. But you can put as little down as 3%, 5%, 10%, whatever, just as long as you do have that 3% requirement.
And I think this is a big issue as well. What's the cap on conventional loans right now?
The conventional loan cap is above 700,000 now.
Oh, it is. Geez. I'll show you the last time I looked at it. I thought we were still in like the fives or something like that.
No, we're north of 700,000. There's another cap as well. It's called a Fannie Mae high balance, where it's zip code specific. So if you were to lend in Aspen, that has a higher number than it does here in Denver.
Okay. Now, and just in terms of volume, what are you seeing happening up there in Colorado right now in terms of new loans and versus where it might have been a couple of years ago?
Oh boy, we're probably about 50% off.
Because I'm guessing that probably when you look at what's happened just in the bond market, I mean, everything's really, really based on what the Treasury is trading at. And you went from rates below 1% in the 10-year to 4.5% and fluctuating pretty rapidly right now. I mean, that's just a massive, massive increase. Where are your rates settling out now for high quality buyers?
So today, I'll give the credit union plug here a little bit. Credit unions right now are only originating about 7% of all the mortgages in the United States. Today, if you look at the national average of what rates are, it's sitting at about 7.21%. Colorado Credit Union today, we're at 6.875%. So credit unions in general will have just a little bit lower rates, better fee structures, and hopefully better service as well.
Now, describe the difference between a credit union and a bank or someone that went out to a mortgage broker to originate a loan.
Yeah, very simple. Banks do not like credit unions, and the simple reason for that is credit unions are not for profit. We do not pay federal income tax, and if you're a member of Colorado Credit Union, you have the same equal rights if you have $5 in your account or if you have $1 million with Colorado Credit Union. So our memberships, we treat everyone the same. We're not fighting for our stockholders and that sort of income, generating that sort of income. We in turn give it back to our members, and hopefully better dividend rates, better CD rates, better mortgage rates, that sort of stuff.
Now, how about versus a pure mortgage broker? Because there's a far less of them out there today because obviously the volume's down. It's not there to support it. But right. How would you guys compare, or a bank compare to your mortgage broker?
Yeah, so the difference is we have other ancillary sources of income, whether it's doing loans, fees, other things that can generate income within a financial institution. Mortgage brokers are there solely right now to produce mortgages. And unfortunately, there's not enough mortgages going around. Their rates and their fees are fairly exorbitant compared to what you could obtain at a credit union.
Yeah, and you tack that on top of 7+%, and it gets pretty pricey quickly, I guess. What are you seeing in terms of any kind of federal policy or also state policy specific to Colorado that is impacting what's happening either in the real estate market or also in the lending market?
Let me think about that. That's a good question. Obviously, we have a huge discrepancy right now in terms of fair lending. That's a real hot button right now in terms of our auditors, is making sure that people are giving the equal opportunity to become homeowners. And unfortunately, the data suggests at this point in time that there are some discrepancies and disparities and some issues within lending and how that fair lending is working its way through the process.
Is it fair lending in the basis of, or are we talking when you guys see a mortgage or a borrower come across the board, are you lending to them 100% based on what their financial capacity is to pay that loan, or are there other things you have to consider?
Well, right now, you run everything through Fannie Mae's desktop underwriter, which is an automated underwriting system. Fannie Mae is the one that says yay or nay. We are selling 90% of our loans to a third-party servicer who eventually will sell the loan to Fannie Mae. In terms of portfolio lending, that's another great thing about a credit union, where we can make decisions based off of membership history, other ancillary things that may not fit in a box in terms of the normal courses of underwriting.
Yeah, and not to put you on the spot with it, but I am curious in terms of when you're talking about fairness in lending, are we talking about DEI stuff where you have specific demographics of the population away from financial ability to pay that might be getting a preferential look when it comes to lending?
That's correct. That's correct.
And is most of that coming down from the federal government, I'm guessing?
Yes.
Okay.
Yeah.
And what other kind of either constraints or issues you dealing with both at the state or the federal level?
So there's some new appraisal standards coming down right now in terms of that fair lending, where the data suggests that potentially one group of people compared to another, that they'll have a different appraisal outcomes. So that's another kind of hot button that we're fighting through right now. And in terms of the state, not much coming from the state that I'm aware of.
Now, you've been fortunate to be in a state like Colorado, which obviously the growth there that you've seen over the last decade plus has been absolutely massive. Are you seeing now still?
Are you saying that's fortunate?
Well, it depends. Depends. That's the one. It depends, I guess. For Colorado in the Front Range, have for sure dramatically changed. We'll say there's a lot more traffic on 25 and 70 heading up into the mountains. There's no question about that. But if you're looking to make money selling real estate, it's been pretty positive to have all that California money come in.
Yes, that's fair enough.
Have you seen a slowdown in terms of that shift and that population shift to a state like Colorado, is based on just the unaffordability you've got in the Front Range right now?
Yeah, for the first time, the city of Denver actually had a declining population in the last 10 years. And that's equated 100% due to the affordability of homes or the lack of affordability for homes and people moving out of the state.
Now, are they moving out of the state, or are they just moving out to the more far-flung burbs of Denver?
Most of them are moving out of the state.
Where are they going?
The main place we see is actually east to the south. So we're seeing a lot of people moving to Georgia, South Carolina, North Carolina, Florida, and so mainly to the south, I would say.
Got it. Now, I've got kind of a theory here in terms of when we're going to start seeing some price discovery in the real estate market, because we opened with talking about the fact that it's hard to say what your houses are really worth because, quite frankly, there's just not a lot. There's not a lot trading right now. If we saw the Fed maybe do a cut or two, coming in this year as they thought, like what interest rate do you think you would start to see sellers maybe take another look at selling their house and moving up into something more? Because everyone's stuck in this trap where if you have a mortgage, you got your 2 3/4, 3.25% mortgage, and you can sell your house, and you're probably, at least in Phoenix, I can speak to this, you're gonna make a lot of money if you sell your house, but anything you buy is gonna be that much more expensive, and you got to refi now at high 6s or 7, and you're probably going to be adding debt load onto that. So is there an interest rate that you think maybe that people have expressed to you that they might come out of the woodwork a little bit and say, you know what, I'm not going to sell my house if I got to refi it 6 7/8, but I'll sell my house and refi at 5 3/4. Is there a number like that out there?
Yeah, my gut tells me it's going to be around the mid fives that people are willing to start moving a little bit. It's just like you had mentioned. I mean, you have a 2.5% interest rate right now, and you want to go buy a new home. Your monthly payments are going to go up by $2,500 to $3,000 a month in terms of the mortgage payment, and that's just not sustainable.
On your average house?
Yeah.
Yeah. Now, let's say we get into this world where, because I think that the inflation's proven to be a little bit stickier. A big issue, if people ask me what keeps me up at night, it's actually really not the stock market. I mean, you get very used to, if you've been an investor in the stock market for a long period of time, I tell clients this, probably 1 out of every 4 or 5 years is really going to stink. One's going to be kind of okay. You're going to get a couple that are going to be really good. Meaning there's 20% declines in the stock market. They're really ugly and they're painful when you're in them, but you kind of come to expect them. Bond investors, which really is the foundation of everything we're talking about here today, are not used to taking losses. They took big losses in 2022. And I think there's a thinking, at least from some people I talked to, well, we took the hit in 2022. Rates are now kind of stabilizing. They're not going to go up from here. But you look at the 10-year, it's sitting at 4.5%. Historical average is about 6.5. There's nothing to say it can't go up to those levels. And with rates still historically very low. I mean, my first mortgage was almost 9 in New York back in the late 1990s. What happens to the mortgage market if we saw a sustained 5% on the 10-year, a sustained 6% on the 10-year? How do you see that playing out?
Well, I think from what we have here in Colorado, even today, where rates are 6.75, 7%, our average day on market in terms of a home, once it hits the MLS, is under contract within 8 days. So there is a lot of demand. I'm afraid that with more demand, that's just going to cause prices to continue to increase and make the affordability just that much harder. So it's just a double-edged sword here in Colorado, because you have the demand, the money is there, and people are just kind of waiting for the potential. And the other thing we had as well is we had a lot of investors come in and buy hundreds and thousands of houses in Colorado and turn them into rentals, just due to how strong of a market we do have here in Colorado. So there's a lot of money on the sidelines, and when rates come down, I just the competition for obtaining a home is going to be just twice as bad as it is today.
Now, what about, I think a hot button issue now, of course, is what you're looking at, Wall Street money coming in and buying a ton of houses. Are you seeing that in Colorado? Unfortunately, I'm very against that. As a person that has made their living both in New York City and here, obviously in the space that I occupy today, I think that if you take away, you don't want a nation of renters. You want people that can own their own home, that have some skin in the game, that have a desire to maintain and keep up their properties. And I don't like the fact, and you see it here in Phoenix as well, when you see very, very large pools of institutional money essentially pushing the average person that is living in that neighborhood out of the market. Are you seeing that in Colorado as well? And how's that impacted the dynamics of just a young couple that might be wanting to buy their first house and raise a family? Is that part of what's pushing them out, as well as interest rates?
Absolutely. I'll give you an example. I worked with a gentleman about 18 months ago who moved from New York, sold his flat for an exorbitant amount of money, came here on a 1031 exchange, and bought 47 properties within 30 days. That, unfortunately, are the properties in which the younger generation and first-time homebuyers are looking to buy. He's the type of investor that doesn't necessarily have the care about what the price of the home is. He's only concerned about what the cap rate and what the return is on that investment. And as long as those numbers work, he's willing to keep buying.
And what kind of cap rates? Sorry, go ahead.
Okay.
And what kind of cap rates are the investors looking at up there?
Well, back then it was about 7%.
Got it. So this is a couple of years ago, I'm guessing, when you
Yeah.
did this. Yeah.
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 I said
Yeah. I
18,
think,
could have been 24.
yeah, I think it's a massive issue. Now, we've talked about obviously all the problems that are occurring right now. What are some of the better bright spots that you might see happening in both the real estate market and also the lending?
I think the quality of homes that hit the market today are much better in terms of the condition of the home, the shape of the home. I think people during COVID, when they were all stuck at home, they were forced to fix their home. So we're seeing a lot better quality in terms of the properties that do come up. I think there's there's the ability and there's a lot of uh, well, for instance, in Colorado, we have a situation if you're a developer or a builder that X% of the properties that you're building, especially in condo complexes, have to be allocated to low income families. I believe that's 10%. That's a good thing. I think that the lending practices are very much buttoned up compared to where we were. And not only that, foreclosures are a very low percentage right now. Not to say that it's going to stay there, but people are finding a way to pay their mortgages right now, unlike back in 2008, 2009.
Yeah, you think that's because actually in most cases, incomes, in almost every case, I would say, income's actually verified. You can't just fill in that number like you
That,
could in 2007.
that's correct. That's correct. Some people will say that, with the government and all the subsidies and all the checks that were written during COVID, people have money in their savings. I'm not sure that's the case anymore, but inflation is really low right now considering
Inflation is low, meaning considering what?
considering how expensive groceries and gas and insurance and that sort of stuff. Where we've seen here in Colorado, I'm not sure about other parts of the country, where we've been absolutely destroyed by 100% increases in property taxes, as well as 100% increase in homeowners insurance.
Okay, so property taxes, you're seeing that on a local level as well, really increasing pretty dramatically. Are
Yeah.
there different areas in Colorado along the Front Range there that are better in that regard, and some that have hurt homeowners more?
It's pretty much across the board in the whole state of Colorado. And I know that our local or our state government is working on a new proposal, but it's not getting very far. And the rules that are in place right now are really, really going to have an adverse effect on people who do own homes, who have bought a home today. And then next year, when they have an escrow account analysis and their mortgage goes up by $500 a month, it could cause to some of that more foreclosure situation.
Yeah, and I guess in a state like Colorado, there's not. Ironically enough, there's protections against that in California, a state like California, where they're limited in terms of how quickly they can increase the property tax. Am I right on that?
I believe California is just based off of the purchase price.
Okay,
So it's 1.25% of whatever the purchase price is, regardless of if there is increase in values.
got it, got it. Now, also in Colorado, or in California rather, I've heard that there's a proposal for people that have arrived here in the country recently, I guess we'll put it that way, where there was a proposal to essentially pay the interest on their mortgages. Have you heard about that?
I've heard bits and pieces of that.
Okay.
Right now, we do not have the ability in terms of Fannie Mae to be able to lend right now with people with an I-10 number.
And
But
I-10
I
number is
think
what?
they're basically their social security number, but it's not a social security number.
Okay. Are you seeing not to get too off track in terms of what's happening in the mortgage market, but you've got a lot of illegals that have crossed the border. We have a ton of them here in Arizona. There's no question about that. We've got a lot more than we did 2 years ago, that's for sure. Are you seeing more of that in Denver as well? And is that in some way affecting affordability, because you now got the federal government that's essentially paying to house these people as well?
Yeah. So Denver per capita, my understanding is that we have the most immigrants in the city and county of Denver compared to anywhere else in the United States. It's a huge problem, and it really is affecting, housing pricing and values in downtown, and a lot of people are moving out of there.
Yeah, I think that's an interesting thing. People want to dance around it. I won't. I mean, when I first came to Arizona here, now it's been about 17 years or so ago. You never saw a homeless person ever, almost never. And I came from New York City, where at that time, very rarely did you see homeless people back. New York was a pretty clean place at that point. I will say that in the last 2 years, really, it's been extraordinary. The number of people that are on the streets now, not that far away from where we're broadcasting this right now. I mean, we're talking about, in some cases, hundreds of people in certain areas. So the fact that this is happening, it's definitely real. But I also think what we've seen here in Arizona is, I live in a part of Phoenix, and you're seeing a lot of people wanting to move out of the part of Phoenix that I live in, or considering it and going into a place like Paradise Valley, because they've got their own police force. They're not subject to the what the city government of Phoenix is saying. And it's definitely changed. It's caused some disruptions for sure, at least in what decisions that people are making in terms of their housing. I mean, what's your outlook looking forward in terms of do you think that we've, like, the hit's been taken in terms of mortgages? Or what point do you think people are gonna say, okay, this is just the world that we're living in. If I need to buy a new house, I need an extra bedroom because we got more kids on the way. Now's the time to do it, and I'm just not going to wait until we see those interest rates fall. Or are we not there yet? Is it going to take some time to free up that market? Because I would guess it's really not new construction, but it's existing home stock that people are not moving out of because they don't want to. Again, they don't want to lose those rates. Are you starting to see some people kind of throw in the towel and say, "Look, I got to move. I've been in this house for 5, 6 years now. We need more space. We need to get in a different school district or something like that."
Yeah, I'm cautiously optimistic. I feel that you always have the ability to refinance a loan, and I don't believe that rates are going to stay where they're at today. I think eventually, in the next 12 to 18 months, we might see a little bit of an adjustment downwards. And you can always refinance, which is a good thing, and take advantage of those lower rates. It's not as though you're stuck in a 7% mortgage for 30 years. You always have the ability to take advantage and refinance that loan. Just need to make sure that you're financially capable of making those payments, and not extending yourself beyond what you're comfortable with.
Yeah, I think that's great advice. And any foresight in terms of what you think the Fed will end up doing and where we could see mortgage rates settle in, say, that 12 to 18 months?
Well, I would love to see them in the fives. Not sure if that's obtainable or not. I just every report that I see is inflation is worse than what it should be, and so it's just, unfortunately, like you said, it's just sticky right now.
Yeah, yeah. I think it could be for a longer period than people think. I think that that there's a lot of federal debt that's being issued right now. You've got to have a reasonable rate of return for investors to buy that, and that's really driving what the mortgage rates are. I mean, that mortgage rate's going to be pinned to whatever the Treasury number is at 10 years. It'll be some spread based on that, and until that gets maybe a little bit more under control. I think we could have higher rates for a longer time than either of us anticipated. Last thing, what about in terms of, you talked a little bit about some of the differences in working with a credit union, but if you're not looking for a mortgage, who are some of the people that should be working with you? What are the
I'm sorry,
services you're offering up there?
and so obviously, auto loans are a great resource for credit unions. CDs are a great source of for credit unions. Money market rates are phenomenal with credit unions. Um, what else?
What kind of rates are
Home
you
equity
talking about
lines of
now on all
credit,
those things?
huh?
What kind of rates are you talking about on all those things? Where are your auto loans coming in now?
So auto loans are about 6.5%.
Okay.
Equity lines of credit are about 8.75%. CDs, I believe we're at 5% for a 6-month CD.
Okay. How about money markets?
Money markets are around 3%.
Okay. Now, if anybody wants to reach out to you, either to park some cash somewhere, buy a car, buy a house, how do they find you?
You can always find us at our web homepage, ccu.org, or my direct line. You can call me anytime, 720-981-2315.
Awesome. Well, yeah, we've had really good experiences on the lending side, working with credit unions. So I think a lot of not to knock our friends at the banks or mortgage brokers, but that's usually the first place on a mortgage that I would suggest people start and look due to some of the reasons that you had outlined earlier. I think that in many cases you're going to get the best rate for sure there. So I'd encourage anybody, and I will add, you are in Colorado, but you have done lending for both my mother and then also some of our clients down here in Arizona. So you're not just confined to the Front Range there in Colorado. You can lend in several states. Is that pretty much across the board? Is there any place in
Every state.
every state?
Yep.
So Kim is for sure a national resource to anyone that wants to get a handle on what's going on and see what some of their borrowing opportunities may be. So Kim, thank you so much, man. And I appreciate you taking some time out of your morning to discuss this with us.
Yeah, thank you, Brett.
Yeah, great conversation and a timely reminder, Brett, that there is another option besides the mortgage broker or the bank. People, I think, forget about credit unions often. If people are listening to this podcast who want to get a hold of you, Brett, how do they reach out to you?
Yeah, you can call us here in the office, 602-255-0555. Myself or a member of the team will pick up. Pretty active on LinkedIn, usually put stuff up there almost every single day. And our website is on tws.finance or smartmoneysimplified.com. And all our contact information is on there.
That's fantastic. The other thing you can do, listeners, if you are listening to this for the first time, is you can become a subscriber. And that's very easy. All you have to do is reach out and hit the follow button. You subscribe. The next time Brett drops an episode of his podcast, you'll be notified and you can listen to it. I would ask that if you find this podcast useful, interesting, helpful, even entertaining, tell people about it. Word of mouth is a welcome piece of promotion. Until next time, I'm Bill Tucker, thanking you on behalf of Brent and everybody at the Wealth Stewards. Thank you for taking the time to listen today, and I will remind you that you can go out today and make today a great day or not. It is up to you. Thanks so much for listening. Until next time.
Thank you for listening to Smart Money Simplified. Have questions about topics covered during the show? Visit our website at www.smartmoneysimplified.com or give us a call at 602-255-0555. Don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of the Wealth Stewards or concurrent investment advisors. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.